Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing the real impact of the latest rounds of Fed hikes on you, your family, and your financial future. So the Fed just raised rates again, 75
Again.
basis points, right? Again. This wasn't shocking news to anyone as the Fed alerted us to it, and also the rate hike was baked in basically at this point. What was a bit of a surprise is the Fed language seems to have changed a little bit. Do you think that they're going to slow down the pace of rate hikes in the future or even pause it? Like
Uh,
near
you know,
future?
it's hard to say because I think we may see a pause after December's hike and
Mhm.
wait and see where it goes. The Fed kind of hinted to that,
Yeah,
and it kind of threw out that maybe we may see a slowing down of rate hikes by the next two meetings, which the
right.
very next meeting is the December meeting,
December, right?
and then the one
Mhm.
after that. So
March, right?
possibly. But everything's now, Michelle, is going to be future hikes are going to be data dependent, especially in the labor market, which we just had that labor report
Report,
this morning, and we got
right?
another jobs report coming this Friday, still showing signs that the job market is strong.
Yeah, yeah. So let me ask you this question: is there a possibility of severe damage because of these continual rate hikes? For example, you know, like could this send us into a recession in 2023? Do you think this is a real possibility or is this just more hype? I mean,
Uh,
nobody
you know,
can, let me just preface this. No one can tell the future.
no, you
Unfortunately, we
can't
can't
tell.
predict the future.
No,
What's your
you really
opinion?
can't. And the Fed, according to the Fed, just a few minutes ago, they don't feel they've gone too far yet,
Yeah,
and wants to use whatever tools they have at their disposal to get inflation down to their 2%. That's their goal.
right.
And I think we have a strong economy, though, Michelle. And looking at the numbers, and history has shown that raising rates is actually a good thing for the
Yeah,
economy.
especially
But
for
we've had,
savers.
oh, that too. Yeah,
Right.
finally, savers get paid. So,
Right. But so here's, the thing is you can't really save when inflation is so flipping high or it makes
yeah,
it harder, right? And 2% is a really long way to go. Inflation
it is.
hasn't broken out to the downside despite
No.
these rate hikes, and people they're hurting as inflation has seriously eroded their purchasing power. Data is showing, the shift in purchasing behavior to buying
Right.
essentials and slowing down just on discretionary spending. And the problem with that is they're focusing on essentials, but they can barely afford, and not everybody, but a lot of people can't afford basics like gas and food and shelter. So
Sure.
I guess they have a ways to go to get this under control. And I suppose only time will tell. So let's move forward here and talk about the impact, the market impact.
Sure. You got the market phrase out there, don't fight the Fed.
Right.
That works in both directions. If the market feels that the Fed's going to slow rate increases, they will try to get ahead of this move.
Sure.
Markets are a leading indicator and will lead that way higher if they feel that that is where the Fed is going to go.
Okay. All right. So I want to get into the real impact of these Fed rate hikes. But before we get there, if you like the content of this video, hit that like button, help us grow this channel.
Thumbs
Do
up.
not forget to subscribe. Brian and I put out videos pretty much daily these days, and help you make the best informed financial, what is this? To
Decisions.
help you make the best informed decision about your financial future. All right, so Brian, let's start with the real impact to credit cards.
Yeah, you'll see credit card rates usually rise by the same percentage as the Fed rate increases. These
Mhm.
these are the variable rates. They usually adjust within one billing cycle, sometimes quicker than that. Same as variable rate loans. These increases will mean, of course, higher APRs and longer debt payoff periods for cardholders. So just
Sure.
remember that. So
Okay. So, and if you carry a balance month to month, it's going to jack up the
the
overall
total
interest,
interest that you
right?
pay.
Yeah.
Yep, it's going to go against you. And this is a big one for consumers, especially when we're starting to see reports of consumers putting more credit,
Right.
increasing their credit card debt.
Yeah.
And it's going to be tough for them to bring down the balance and pay it off as quickly as possible. It isn't going to happen. So,
Yeah. So, what about loans with adjustable rates? They'll also see an impact, correct?
yeah, personal loans and home equity lines of credits that are based on the prime rate will continuously move up. So we will see that going forward.
Okay. So I want to move on and talk about mortgages and the impact that this this latest, it doesn't even latest. It's really more about the series of rate
Series.
hikes, right?
Yeah.
We're, how it's impacting the housing market. Currently, we're seeing a serious slowdown in the housing market.
Yeah, we are in both, especially in the purchases and the refinances, both sides. Okay. Also, when you start to see massive layoffs of complete mortgage divisions
Thanks.
at banks,
Yeah.
that just tells you that they're, seeing that, oh my
It's a
gosh,
leading
we don't
indicator, as
need
they would
1,000
say.
loan officers to process 20 loans a month.
For
So
sure. So let me ask you this question again. I know you can't predict the future. I wish you could. That would be really great.
here's my
But do you
crystal ball.
think, right? No,
Need
I
one of
lost
them.
it. Do you think that we're starting to see a recession in the housing market specifically?
I'm not sure about a housing recession. Are we slowing? Yes.
Right.
And think about, and here's why. We just came off of a period of the lowest rates in
Right.
history, as well as a steep incline in the cost of housing,
Okay.
right?
Right.
We have definitely overheated in this section. I can say that for us right here in Dallas, the exact same thing. Massive increase. Look, Michelle, would you believe me if I would have told you 6 years ago that 6 years from now, I believe my house will triple in value. It did.
So I would like to say no, but also I lived through 2008, and I know that anything is possible in the housing
Anything's
market.
possible.
So
We had to pull back though. A recession, though, I'm really not sure about that
okay.
because look, you still need housing. It's
Sure.
that simple. So,
Sure.
and there was a shortage of housing going into this. So,
For sure. Okay. So how will these rate hikes impact the labor market, or will they at all? How does that work?
well, let's put it this way. If businesses are unsure of future costs, they're going to begin to scale back. And we're starting to see the slow scaling back, but robust job market still today. They
Right.
may start buckling down on hiring and cutting expenses for future uncertainty. If you don't know where your business is going, you're going to slowly start to come back on it, right?
Right.
Wages aren't coming down though. Wages are still rising. So it's kind of, I
Which
think
is
that's
good
a
because
big,
people can afford
that's
things.
a big gotcha. So the
Right.
Fed's concerned about these raising labor rates. And like I said, we got more job reports coming out this week, and the numbers this morning were not favorable of the stock market. So
No. Okay. So let's talk about I saved the best for last, the good
the
news
good
about the rate
news,
hikes, which of course is saving rates. Let's chat about that and how that impacts
you are
consumers.
now finally making money if you're a saver. It's that
Finally,
simple.
right? Your 0.0000001% is gone.
I mean, I get hundreds of emails and they're all coming in. Oh, we just raised the rates. Oh, the rates are up again. The rates are up again. And from CDs to bonds to high yield savings accounts. Same thing with MIGAs and fixed annuities. We have not seen these rates since 08, 09 during the middle of the financial crisis.
All right. So here's the deal. If you liked the content of this video, hit that like button. Don't forget to subscribe. And if you have comments, we'd love to hear how are these rate increases impacting you, your family? What's going on? Give us give us a comment below. We're always responding to those. So Brian, before we wrap it up, is there anything else you'd like to add?
Stay tuned because as data comes in, I think what we're going to see is the Fed is definitely going to be more data dependent moving forward.
Well, they said that, right? This is what
they've said that, but they've been data dependent this whole time. But again, they have a goal. And that goal is we may see some future pain ahead, maybe a couple more months until we start to see some light at the end of the tunnel. But remember, the market's a leading indicator. If the market feels that the Fed is starting to slow down, so any data that is showing a slowdown in inflation or a slowdown in job growth, you will now see the market accelerate to the upside because of it. So just
all right. Well, here's to hoping for the best, because often the road with the road to good intent what is it? The road good intentions. The road of how do you say that? The road of good intentions. The road to good intentions is always the road to hell is paved with good intentions. There you go.
Google it.
Blah blah blah. All right. So Brian, thank you so much. Thanks to everybody who watched. Again, leave us a comment below. Let us know how this is impacting you. Don't forget to like and subscribe so you don't miss another video from us.
Yep,
Have a
definitely.
good one.
Thanks, everyone.